Okay, let's unpack this. If you own rental property, you might have hit this wall, right? It's super frustrating. You have real losses from your rentals, maybe repairs, maybe vacancy, whatever, but then you do your taxes.
And boom.
Yeah. You find you can't actually deduct those losses against your salary or, other investment income. They just sort of get stuck.
Oh, yeah. That feeling is incredibly common. Having real cash out-of-pocket losses that you can't use that year.
Yeah.
Yeah, it's frustrating. Definitely one of the biggest tax hurdles for rental owners.
Exactly. And that specific problem is what this deep dive is all about. We want to cut through that complexity. We're going to show you the actual pathways the tax code gives you to deduct those rental real estate losses, even with the general limits.
And we're going straight to the source here.
Right. Internal Revenue Code Section 469 and the IRS's own guide, Publication 925, Passive Activity and At-Risk Rules.
So our mission today, really, is to give you the blueprint, the key rules you need to understand so you can navigate this and hopefully unlock those deductions. Think of it like a map.
A map to buried treasure, deductible losses.
Exactly.
Okay, so let's lay the groundwork. The whole reason this problem exists is because of passive activities, right? The tax code generally limits losses from anything it calls passive.
That's ground zero. So according to the IRS guidance, a passive activity is defined in, well, basically two main ways.
Okay.
First, it's any trade or business activity where you don't materially participate. You're not really involved hands-on.
Right, kind of like a silent partner.
Yeah, something like that.
Right.
And second, and this is the big one for us today, it's any rental activity.
Wait, hang on. Any rental activity, like automatically?
Pretty much, yeah, by default.
Even if I'm super involved, like I screen tenants, I fix the leaky faucets myself?
Generally, yes. That's the key distinction.
Yeah.
Unlike, say, running a shop, where if you materially participate, it's not passive. Rental activity starts out presumed passive, even with participation.
Wow.
Now, hold that thought because there's a huge exception to that rule, and that's one of our main pathways. But the starting point, the default setting, is rental equals passive.
Okay. That explains why these losses get stuck initially. And who exactly do these passive activity rules apply to?
Mostly it's individuals, also estates, certain trusts, personal service corporations, and what they call closely held corporations.
And if I own the rental through, say, an LLC taxed as a partnership or an S corp?
Rules flow through to you. The limits apply to you personally as the partner or the shareholder.
Got it. And the passive activity loss itself is just, well, when your deductions from all your passive stuff are more than the income from all your passive stuff.
Exactly that. You add up all the passive income, add up all the passive deductions. If the deductions are bigger, you've got a passive activity loss, or PL.
So the challenge is clear now. Rental activity is passive by default. That loss goes in the passive bucket. And passive losses can generally only offset
Passive income.
Right. So if you don't have other passive income streams, like from a limited partnership or another rental that is profitable, that loss from your rental property is just stuck.
Precisely. It usually can't touch your active income, like your job salary, or your portfolio income, like dividends or interest.
But it's not gone forever, is it? If a loss is disallowed 1 year, it carries forward.
Correct. Thank goodness for that, right? Disallowed passive losses are suspended. They just kind of hang out, waiting.
Waiting for what?
They can be used in future years if you have passive income then. Or, and this is key, they can often be fully deducted when you finally dispose of the entire activity.
Okay, good. So there's hope. Enough about the problem. Let's talk solutions. How do we unlock these losses? Pathway number 1 you mentioned, the special $25,000 allowance.
Yes, this is a really important one, specifically for rental real estate. It's a specific exception carved out in the rules.
What does it do?
It allows individuals who have passive rental real estate losses to potentially deduct up to $25,000 of those losses against their non-passive income.
Against non-passive income, like my salary.
Exactly, like your wages, your salary.
Yeah.
That income that's normally off limits to passive losses.
Okay, that sounds pretty good. What's the catch? There's always a catch.
Oh, well, the main requirement is you have to actively participate in the rental activity.
Active participation. Okay, how's that different from the material participation you mentioned earlier?
It's a lower standard.
Yeah.
Easier to meet. The guidance talks about making management decisions in a significant and bona fide sense.
Meaning?
Think about the important landlord decisions. Approving new tenants, deciding on the lease terms, approving major repairs or expenditures. You don't have to be the one swinging the hammer.
Okay, so it's about being involved in the key decisions, the strategy, not necessarily the day-to-day labor.
Exactly. You're the one making the calls. Also, generally, only individuals can actively participate. And there's an ownership requirement, too. Which you have to own at least a 10% interest by value in the property. And that ownership needs to be there throughout the year. There are some specific rules for estates, but for most people listening, it's about you individually owning at least 10% and making those management calls.
Got it. And the amount is up to $25,000 a year. Does that change if you're married?
It does. It's $25,000 total if you're single or married filing jointly. But if you're married filing separately, it gets tricky.
How so?
If you lived apart from your spouse for the entire year, your limit is half, $12,500. But if you're married filing separately and you live together at any point during the year, the allowance is zero, gone completely.
Wow, zero. That's harsh for married filing separately but living together.
It really is. It makes filing status a really important consideration if you might use this allowance.
Okay, so active participation, 10% ownership, and the amount depends on filing status. But you mentioned a catch. Is there another one?
The biggest one? Probably. The income phase out. This $25,000 allowance starts to disappear if your income gets too high.
Okay. How high is too high?
The allowance starts getting reduced once your modified adjusted gross income, or MGI, goes over $100,000.
MAGI. Okay, modified AGI. That always sounds like a special calculation. Is it?
It is, slightly. For this specific rule, you start with your regular adjusted gross income, your AGI from your tax return. Then you add back certain deductions you might have taken. Things like IRA deductions, student loan interest deduction, deductions for tuition and fees. And crucially, you also don't subtract the passive loss itself that you're trying to figure out on Form 8582. You also add back taxable Social Security and any rental loss allowed because you're a real estate professional. That's our next pathway. It's basically trying to get a measure of your income before some of these specific deductions and the passive losses themselves.
Okay, so it's like a truer measure of your total income for this purpose. And once that MGI number hits $100,000.
It starts phasing out. The allowance is reduced by 50 cents for every dollar your MGI is over $100,000.
50 cents on the dollar. So by the time your MGI reaches $150,000.
It's completely gone. The full $25,000 allowance has phased out. $150K, $100 below excess, 50% of $50K is $25K reduction.
Right. And for married filing separately, I assume those numbers are halved.
They are. The phase-out starts at $50,000 MAGI, and it's fully gone by $75,000 MAGI for MFS folks who lived apart all year. Remember, it's zero if they live together.
Let's make this concrete. The guidance has examples, right? Like Terry, single, $70K wages.
Right. Terry has $70K in wages, also $15K of passive income from maybe a limited partnership, and a $26,000 passive loss from a rental property. Terry actively participated.
Okay. So Terry's MAGI is under $100,000, right? $70K wages plus the $15K passive income. Well, the MAGI calculation is specific, but let's assume it's under $100K based on the example outcome.
Correct. Since the NGI is below the threshold, the full $25,000 allowance is potentially available. Now, how does the loss get used? First, passive losses offset passive income. So Terry's $26,000 rental loss first wipes out the $15,000 passive income from the partnership,
leaving $11,000 of the rental loss remaining, $26K, $15K go.
Exactly. Now, because Terry actively participated and is under the income limit, that remaining $11,000 loss can use the special allowance. It can offset Terry's non-passive wage income.
So the entire $26,000 loss was deductible in the end. $15K against passive income, $11K against wages.
That's right. Fully deductible in the current year. It worked perfectly for Terry.
Nice. Okay, now compare that to the second example. Single taxpayer, $120,000 salary, and a $31,000 passive rental loss. Also actively participated.
Okay, now the MGI is $120,000. That's over the $100,000 threshold.
By $20,000.
Right. So we need to calculate the reduction in the allowance. 50% of that excess amount, 50% of $20,000 is $10,000.
So the maximum $25,000 allowance is reduced by $10,000.
Correct, leaving an adjusted allowance of only $15,000, $25K, $10K.
So out of that big $31,000 rental loss, only $15,000 can be deducted against the salary this year.
Exactly. That's the limit imposed by the phase-out.
And the rest, the other $16,000, $31K, $15K.
That $16,000 is a disallowed passive loss. It gets suspended and carried forward to future tax years.
Wow, that example really shows the bite of that phase out. Just going from under $100 to $120K MAGI cut the usable loss significantly. And by $150K, it's zero allowance.
It's a critical threshold. If you're relying on this $25K rule, you have to watch your MAGI. The guidance does mention some exceptions where the phase out is higher, like for certain rehabilitation credits or low-income housing credits. But for typical rental losses, That 100K to $150K range is the key zone.
Okay, so pathway 1,
Oh.
the 25K allowance. Useful but limited by active participation and that income phase out. What's pathway 2?
Pathway 2 is the big one, potentially. It's qualifying as a real estate professional.
Ah, the pro status. I've heard about this.
If you qualify, it can fundamentally change the game. It allows your rental activities to potentially be treated as non-passive.
Non-passive, meaning the losses aren't limited by the passive activity rules at all.
That's the potential outcome, yes, which means those losses could be fully deductible against any type of income, wages, investment income, whatever, subject to other rules, of course.
Fully deductible. Okay, that sounds powerful. What does it take? How do you qualify?
It's tough. You have to meet 2 specific tests laid out in the guidance, and you have to meet both of them for the tax year.
Okay, test number 1.
Test 1. More than half of the personal services you perform in all your trades or businesses during the year must be in what they call real property trades or businesses, where you materially participate.
More than half my total business time. So if I have a demanding day job, this is hard.
Very hard. Your real estate work has to be your primary focus in terms of hours spent across everything you do for business.
Okay, what's test number 2?
Test 2. You must perform more than 750 hours of services during the year in those same real property trades or businesses where you materially participate.
Wow. Okay, so let me recap. Over half my total business time must be in real estate businesses. And that time in real estate businesses has to be more than 750 hours for the year. And I have to materially participate in those specific real estate businesses where I'm counting the hours.
You got it. It's a triple hurdle. Significant time commitment, primary business focus, and material involvement.
What counts as a real property trade or business?
The definition is pretty broad, actually. Things like development, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, or brokerage of real property. So being a developer, a builder, a landlord, a property manager, a real estate agent, or broker. Those generally count.
What if I work for a real estate company? Do my employee hours count?
Only if you own more than 5% of the employer. Otherwise, employee services generally don't count towards these 2 tests.
Got it. Now, what about spouses? Does my spouse's time helping me count?
This is a point that often causes confusion. Let's break it down.
Please.
Your spouse's participation does count when determining if you meet the separate material participation test for a specific activity, like managing your joint rental properties. We'll get more into those tests later. But your spouse's hours do not count towards meeting the 2 big tests that qualify you personally as a real estate professional. The more than half of all business time test and the 750 hours in real property businesses test. Only your personal service hours count for those.
Ah, okay. So if my wife spends 500 hours managing our rentals and I spend 300 hours, her hours help me materially participate in the rental activity itself.
Right.
But if I also have a separate full-time job taking up most of my time, her 500 hours don't help me meet the more than half my total time test or the 750 hours test to become a real estate professional myself.
Exactly right. It's a subtle but really critical distinction. Her hours help prove participation in the activity, but only your hours count for the professional status qualification.
That is a very fine line. Okay, so assuming I do jump through all those soups more than half my time, over 750 hours, material participation in those real estate businesses, I qualify as a real estate professional. What then?
Then, your rental real estate activities can be treated as non-passive, provided, and this is another step, you also materially participate in each specific rental activity itself, or you elect to group them and materially participate in the group.
So qualifying as a pro isn't quite enough. You still need material participation in the actual rental property activity.
Generally, yes. Qualifying as a pro removes the automatic passive label from rentals. But you still need to show material participation in the rental itself under the normal material participation tests for it to be treated as non-passive.
Got it. But if you do all that, the rental activity becomes non-passive and the losses
Are generally fully deductible against any other income you have, like losses from any other active business. They'd still be subject to other potential limits, like the at-risk rules we need to talk about, or the overall excess business loss limitation, but the passive activity barrier is removed.
Okay, that is indeed powerful. A lot of work, but a big payoff if you can meet it.
Definitely the pathway for people heavily involved in real estate as their main business.
All right, so we have the 25K allowance, pathway 1, qualifying as a real estate pro, pathway 2. What's pathway 3 for finally using those stuck losses?
Pathway 3 is typically the end game, disposing of the activity. Selling the property.
Ah, the final reckoning. So when I sell the rental property, all those suspended losses from prior years finally get released.
Generally, yes. That's the main rule. If you dispose of your entire interest in a passive activity,
Entire interest. Okay.
in a fully taxable transaction where all gain or loss is recognized.
Fully taxable, not a gift or something.
Right, and the buyer isn't related to you under the tax rules, then any previously disallowed passive losses from that specific activity are allowed in full in the year you sell it.
Allowed in full. Okay, so they can offset other income then.
Yes, they can offset other passive income first, then the gain from the sale itself, and then potentially your non-passive income like wages.
What if the sale itself results in a loss? Like I sell the property for less than my adjusted basis, creating a capital loss, and I have carried over passive losses?
Okay, good question. This gets a bit layered. The guidance gives an example. Let's call him Carter. Carter sells his entire interest in a passive partnership. He has $2,000 of suspended passive ordinary losses carried over from prior years. The sale itself results in a $12,000 capital loss.
Okay.
The disposition rule says both the $2,000 prior loss and the $12,000 loss on the sale are now freed from the passive activity limits. They are allowed in that sense.
Right.
However, they retain their character. The $2,000 is an ordinary loss. The $12,000 is a capital loss. That $12,000 capital loss is then subject to the separate capital loss limitation rules.
Which for individuals is,
Yeah.
you can offset capital gains plus up to $3,000 of ordinary income per year.
Exactly. Any remaining capital loss is carried forward as a capital loss. The $2,000 ordinary loss, now freed, can offset ordinary income without that $3,000 limit.
So the disposition unlocks the passive loss status, but the type of loss, ordinary versus capital, still matters for how much you can deduct against other income that year.
Precisely. Two sets of rules working one after the other. Passive rules first, then capital loss rules, if applicable.
What about installment sales? If I sell the property, but the buyer pays me over, say, 5 years.
Yes, the guidance covers that too. If you sell your entire interest on an installment basis, you get to deduct a portion of your total suspended passive losses each year you receive a payment.
A portion. How much?
It's proportional. The amount of suspended loss you can deduct each year is based on the ratio of the gain you recognize that year compared to the total gain recognized so far, plus remaining to be recognized on the sale. The example in the source, Riley's example, shows if you recognize 20% of the total gain in year 1, you deduct 20% of the suspended losses. If in year 2 you recognize, say, 25% of the remaining gain, you deduct 25% of the remaining suspended losses.
Okay, so the loss deduction kind of tracks along with the gain recognition over the installment period. Makes sense.
It does.
Are there times when disposing of the property doesn't free up the losses?
Yes, a couple of important exceptions mentioned in this source. First, if you dispose of the activity by gift.
Giving the property away.
Right. In that case, the suspended passive losses are not deductible by you or the recipient. Instead, they get added to the recipient's basis in the property.
So the loss transforms into increased basis for them.
Essentially, yes. The deduction potential is lost, but it might reduce their gain later when they sell it.
And the other exception?
Disposition due to death. When the owner dies,
What happens then?
the suspended passive losses are deductible on the decedent's final tax return, but there's a catch. They're only deductible to the extent that the total suspended losses are more than the amount the property's basis gets stepped up for the heir.
Ah, the basis step up at death. So you compare the loss to the step up amount.
Exactly. The guidance gives an example. Say there's $8,000 in suspended losses, and the basis step up for the heir is $6,000. Only the excess, $2,000, $8K, $6K, is deductible on the final return. The other $6,000 of potential loss deduction effectively disappears because of the basis step up.
Wow. Okay, so gifting means basis increase. Death means deduction limited by basis step up. Those are really important distinctions for estate planning.
They certainly are. How you transfer the property has big implications for those suspended losses.
Okay, before we wrap this all up, let's quickly hit a few related concepts that the guidance mentions. They seem important for context. First, the at-risk rules.
Absolutely crucial. You have to clear the at-risk hurdle before you even get to the passive activity rules.
What do they do?
They limit your deductible loss from any activity, passive or not, to the amount you personally have at risk in that activity.
Amount at risk. What does that usually include?
Generally, it's the cash you've put in, the adjusted basis of property you contributed, and amounts you borrowed for the activity where you are personally liable for repayment.
So recourse debt counts, but what about non-recourse debt, like a mortgage where the property is the only collateral?
Usually, non-recourse debt does not count towards your amount at risk. Big exception, though. There's something called qualified non-recourse financing, which is common in real estate. If the financing is secured by real property used in the activity and meets certain other criteria, like coming from a commercial lender, it can be treated as an amount at risk.
Okay, so even if my rental loss gets past the passive activity rules, maybe I'm a real estate pro, it could still be limited if I don't have enough at-risk investment, perhaps due to high non-recourse debt.
Exactly. The at-risk rules are the first gatekeeper. If a loss is limited by at-risk, it gets carried forward separately, and you have to test it against the at-risk rules again next year before it even enters the passive loss calculation. You use Form 6198 to figure this out.
Good to know. Okay, we also kept mentioning material participation. You said there were specific tests.
Yes, the guidance lays out 7 ways to prove material participation. The most common one people aim for is participating more than 500 hours in the activity during the year.
500 hours, okay. What are some others?
Well, another is if your participation was substantially all the participation in the activity for the year, or if you participated more than 100 hours, and that was at least as much as any other individual involved. There's also a test combining multiple significant participation activities, ones where you do more than 100 hours, but less than 500 if the total exceeds 500 hours. Plus, tests based on participation in prior years, or a general facts and circumstances test if you meet the 100-hour minimum, but not the others.
And participation itself is pretty broad, just any work you do.
Generally, yes, any work you do in connection with an activity you own. But the guidance does carve out exceptions. Work isn't counted if it's not the type of work owners typically do, and one of the main reasons you did it was to avoid the passive loss rules. Also, work done just as an investor, like monitoring finances in a non-managerial way, usually doesn't count unless you're directly involved in day-to-day management.
How do you prove it? Do I need time logs?
Thankfully, no minute-by-minute logs are required. The guidance says you can use any reasonable method. Appointment books, calendars, narrative summaries describing your work and hours, those are generally acceptable.
Good. And just to reiterate the spouse rule here.
Right. Your spouse's participation does count towards meeting these material participation tests for an activity you own jointly, even if they don't have an ownership interest separate from yours. This is different from the real estate pro qualification test we discussed.
Okay, clear. Another concept. Grouping activities. Why would someone group multiple rentals or businesses together?
The main reason is often to make it easier to meet the material participation tests. If you group several activities together, you only need to meet the participation test for the combined group as a whole, rather than for each separate activity.
So if I own 3 small rentals and I spend maybe 200 hours on each, that's not 500 hours for any single one. But if I group them...
If you group them into one single activity, your total 600 hours would meet the 500-hour test for the group.
Okay, that sounds useful. How do you know if you can group them?
You can group activities if they form an appropriate economic unit. The IRS looks at factors like, are they similar types of businesses? Do they have common control or ownership? Are they in the same geographic area? Do they depend on each other, like shared customers, employees, accounting systems, or maybe one supplies the other?
So there has to be some real connection.
Right. It can't just be arbitrary grouping.
Is there a downside to grouping?
Yes, potentially big one we touched on earlier. If you group activities, selling just one part of the group, like one of your 3 grouped rentals, is generally not considered disposing of your entire interest in the passive activity.
Meaning?
Meaning you usually can't use the disposition pathway, pathway 3, to free up the suspended passive losses specifically related to that one property you sold. You typically have to wait until you dispose of the entire group, all 3 rentals in our example, to unlock the suspended losses for the whole group.
So grouping helps with participation potentially, but can delay using losses on disposition. Another trade-off.
It definitely is. And there are rules about generally not grouping rental activities with non-rental businesses unless very specific conditions are met. Once you choose to group, you generally have to be consistent year after year, and you need to report the grouping, usually on Form 8582 or related schedules.
Okay, one last concept. Recharacterization of passive income. What's that about?
This is basically the IRS preventing certain types of income that might look passive from being used to absorb passive losses from other activities. The income gets recharacterized as non-passive.
What kind of income gets recharacterized?
A common one is income from those significant participation activities where you work more than 100 hours but less than 500. If that activity generates net income, it might be treated as non-passive income. Another example is renting property where less than 30% of the unadjusted basis is depreciable, like renting raw land. The net income could be non-passive.
And the result is, I can't use my rental losses to offset that income.
Exactly. That recharacterized non-passive income can't be offset by passive losses from other activities. Interestingly, the guidance notes that if these specific activities generate a loss, that loss usually remains passive unless other rules make it non-passive. So it's primarily an income side rule.
Feels like the rules are really trying to wall off passive losses unless you meet specific exceptions.
They're designed to limit the sheltering of other income using passive losses, unless you fit into those defined pathways like the 25K allowance or being a real estate professional.
Got it. So finally, how does all this get reported on the tax return? What's the key form?
For individuals, the main form is Form 8582, Passive Activity Loss Limitations. That's where the magic happens, so to speak.
Yep.
You list your passive income and losses, you calculate the $25,000 allowance if applicable, you figure out the overall allowed loss, and track any suspended losses carrying forward. Other forms feed into it, of course, Schedule E for rentals, maybe Schedule C or F, Form 470 and 7 for sales, but 8582 is the central hub for the PAC-AO rules.
Form 8582. Okay. So, wrapping this up. The big takeaway is that while the default is rental losses are passive and limited.
It's not necessarily the end of the story.
Right. There are these concrete pathways, the 25K special allowance if you actively participate and meet the income limits.
Wow.
Qualifying as a real estate professional if you meet those significant time and participation tests, potentially making the losses non-passive.
Right.
Or finally, the disposition rules, which often allow you to deduct all those accumulated suspended losses when you sell the entire interest.
Absolutely. Those are the main escape hatches from the passive loss limitations for rentals.
But it's definitely complex. You've got the at-risk rules layered on top, the specific tests for material participation, that tricky MGI calculation, the pros and cons of grouping. Reading Pub 925 and Section 469 isn't exactly light beach reading.
No, it's dense stuff.
Yeah.
But understanding these specific mechanics is really the key to potentially turning those frustrating, unusable losses into actual deductions.
Which brings us to our final thought for you, the listener. Knowing about these pathways now, the 25K allowance, the real estate protests, the impact of disposition, how might this knowledge change how you approach your rental properties? Could it influence how involved you choose to be in management? How you track your time if you're aiming for pro status? Even how you think about structuring the eventual sale or transfer of the property? What decisions might you make differently knowing these detailed rules exist?
It shifts it from just being frustrated by a rule to maybe seeing the rule book as something you can strategically work with.
Definitely something to chew on. As always, we've dug deep into the source material, but your specific situation matters most. Reviewing those IRS resources, or even better, talking with the qualified tax professional is always a smart move. This has been The Deep Dive.